Okay, welcome. I'm David Adams here for the Q3 market update. So I'm going to give a brief, or at least I'll attempt to make it brief. Typically brevity is not my strong suit, but give a brief market outlook primarily as it relates to Q3 of 2012. There's so much going on, so for a guy in this chair, this is a Super Bowl. And while I'm nervous about the playing field and the competing forces, or the other team, if you will, I'm really excited about the opportunities. So let's start with an update from Capitol Hill. I spent time last month with Andy Friedman, who is an attorney who follows Washington very closely, and he's sought after for a lot of his opinions on elections and fiscal policies. And we talked about how the U.S. debt is now 100% of GDP for only the second time in the United States history, with the first time being in World War II. Look, we're on an unsustainable path. 2011 fiscal spending was $3.6 trillion. That's trillion, not billion, which blows my mind the way we throw away the word trillion. And 2/3 of the spending was mandatory, which means entitlements and interest on our debt, and the rest was discretionary. So we could literally slash all discretionary spending by 25%, and it does nothing to solve our problems. We have to address Social Security and Medicare. And guess what? No changes to either happened in 2011 or so far this year. Our Congress has done nothing to address the problems of the deficit, both sides. In 2011, 45% of families didn't pay $1 in taxes. I just have to point that out. And also in 2011, we saw the lowest effective tax rate since 1958. So taxes are likely going to go up, whether we like it or not. You put the fact that Congress won't make any tough decisions because they, being both parties, are always focused on getting reelected, with the fact that we have a deficit that is growing. I don't see how we avoid it, and that's taxes going up. We seem to be living in a fantasy land in Washington, and if I ever advised a single one of my clients to handle their budget and investments in this fashion, I can assure you that I wouldn't have a successful practice, and I absolutely wouldn't be wasting my time on YouTube given these market updates. Now, on a positive front, I have to point out that I still believe in the U.S. It's the home of the entrepreneur, the most open and flexible society that this world has ever seen, and I truly believe that. The brightest minds all over the world still want to come here, and English is the universal language. Additionally, I listened to our chief economist, Jeff Salt, give multiple examples of companies going back to a phenomenon that we haven't seen in a long, long time, and that is made in the USA. Yes, as incomes and costs rise overseas, coupled with our unemployment issues, I think we're going to see jobs created, albeit slowly. On our own soil, I think these jobs are going to be created, and I think that we're going to go back to the basics of how we grew this fine country, manufacturing. I just don't think the U.S. is done being the U.S., and I can't imagine that we're going to become Europe when we can clearly read their book and see how the last chapter is ending and unfolding right before our eyes. But like Churchill said, and I've used this quote many times, Americans can always be counted to do the right things, only once they've exhausted all other possibilities. True. Europe. I couldn't help but think the other day after reading the headline, world stocks tumble as Spain slides into recession, debt fears mount. Big surprise. And this is news. Then I read a timely article from my friend Nick Murray, who literally went on an editorial tirade about the exact same thing. And he brought up some really good points that I wanted to point out, and I caught myself nodding my head in agreement over and over. So he mentioned in regards to Spain. So here's a socially democratic country in Southern Europe that has defaulted on its debt at least 7 times since 1800. Did you know that? With 24% unemployment. Half of the youth and half of all adults under the age of 35 still live at home with their parents. So they're finding themselves in trouble borrowing money to continue sustaining its welfare system. He then went on to say, am I really supposed to get scared out of the equity portfolio that I've been building to carry myself and my bride through what we hope to be a 3-decade retirement? So is this so-called news? Is that really what I'm supposed to do? So I could go on and on about Europe, but whether it's Greece or Italy, you name them, outlook is still the same. As investors, we need to have a well-balanced portfolio and avoid the crowd at extremes. Many companies have great balance sheets with lots of cash, and owning good multinational corporations with solid cash positions and good business models is a sound way to weather these this financial turmoil in a more effective manner. especially when cash is guaranteed right now to provide you with negative purchasing power. It's amazing to me that you can get dividend yields on solid companies higher than CD rates and government long-term treasury bills. Yet that's where the money is still flowing, telling me that stocks are due a long-awaited run at some point, and there's the big caveat. Yes, at some point. I know that's generic and frustrating, but unfortunately with the media creating all of this volatility, program traders playing the game, it's hard to make any short-term predictions. But let's talk about 7 themes in the current economy that I felt were relevant to discuss today. Number 1, the U.S. expansion has slowed, but it isn't stalling out. 4 things that take you in and out of recessions, light vehicle sales, housing starts, inventories, and capital goods orders are all seeing improvements. Vehicles, as an example, if we kept the current, I think it's $13.7 million cars that are being sold each year, the average person would have to keep their car well over 15 years. That implies that there's a lot of pent-up demand for cars. Also, oil prices are the biggest fear for this slowing economy, but it hasn't happened yet, so lower prices will act like a tax cut for the U.S. consumer. The biggest fear, of course, is the Strait of Hormuz, which has about 18% of the world's oil supply going through it. And the fear is that maybe there's an underwater mine or something that blows up and destroys tankers, causing chaos. We have by far the largest Navy in the world, and our Navy is sitting there guarding the strait 24/7. Also, please keep in mind that housing prices are beginning to turn up, but monthly rent payments are actually higher than mortgages right now. That's crazy. The FOMC projects that rates will slowly increase over the coming years, but expect the long term them to probably get over the 4% range, implying that mortgage rates will be higher. Media, really, I haven't seen the media publicizing this, so renters are still taking their time. And then lastly, the consumers are in better financial shape than a few years ago. We're saving more, our mortgage payments are a little lower. The household debt ratio is around 10.8% versus around 14% in 2007. So what is the implication here? Maybe you consider overweighting U.S. assets in a global portfolio. Okay, theme number 2. Europe is ugly, but I think it's priced for ugly. Europe has taken steps to protect its banks, and European stocks are very cheap. All of them really are cheap, and nobody is touching them. I've heard from clients over and over, what if Germany leaves the EU, the European Union? Germany has 40% of their GDP as exports, of which half of those go to the Eurozone directly. During the Great Depression, to put that in perspective, we lost over 20% of our GDP. Now, for the U.S., we only export about 9.8%, and only 1.5% of our entire GDP is exports to the Eurozone. The implication of this, consider cheap European stocks with global reach in small doses. Okay, number 3. U.S. equity valuations are cheap, and I think valuations matter. PE ratios are low across the board. The average S&P is around 16.3. It's now around 12. So the PE now is really well below the normal recessionary PE ratios. So what does that mean for the stock markets? Look, over 1 year, who knows? But over 5 years at this valuation average, the return historically has been double digits. And the implication here is long-term investors should overweight U.S. equities. Number 4, let's talk about bonds. So bonds overall look expensive, but we think there are opportunities. The long-term treasury yields are way low. We had a 30-year bull market in bonds. So let's say, what if rates go up 1%? What does that mean for my bonds? Something to consider. High yield spreads are high. High yield defaults are low. So a lot of the bad have been weeded out. Okay, let's talk about theme number 5. We think that the fiscal cliff is likely going to be avoided, but taxes are going to go higher. The Fed is really trying to lower deficits, but the deficits are currently forecasted to go higher, which means that taxes will have to likely increase. We need more revenue. And while maybe not the biggest fan of a tax hike in this type of economy, keep in mind that we are seeing historical lows for taxes. Now, I must point out that the top 5% of wage earners pay around 60% of all taxes. And the goal of these future tax hikes, according to Andy Freeman, was to make that around 90%. So the implication here is we think that our wealthier investors in particular should consider tax-aware strategies before 2013, and certainly as we go into 2013. Okay, we're wrapping up here. Theme number 6, the payoff to education remains huge. And what I mean by that is those with less than a high school degree, the unemployment is around 13%. But with a college degree, it's only around 3.9%. Compare that less than high school degree, $30,000 a year salary, with that of $87,000 for those with a college degree or higher. Something important and something to consider. Okay, number 7, my last theme, and that's that of a balanced strategy. We think it's designed to help even in the toughest of times. And what I mean by that is a balanced perspective on the economic and financial environment is really the best way to help investors really adopt a long-term winning approach to investing. Okay, a couple quick points. There are my 7 themes. I just finished meeting with some long-term clients of mine, and we were talking about how much cash that they are holding on to, mainly because they are uncomfortable with the direction of the economy. So the husband then went on to explain to me how his company was also holding, I think it was hundreds of thousands of dollars of cash, and they could easily buy another business. But guess what? They're not. And we could all argue all day about Obama this or Romney that, but all that really matters is that whoever is in office gives these business owners confidence and clarity to understand the rules of the game for the next 4 years so that they can put that money to work. If they don't feel good and confident about spending the money and doubt the administration's policies or tax plans, this economy is not going to grow. It's as simple as that. So let me end on this note. The late great political scientist Edward Banfield of Harvard concluded that after 50 years of research, that the single most accurate predictor of upward social media and economic mobility here in the U.S., more important than family, background, race, intelligence, connections, network, education, etc., is long-term perspective, the ability to think ahead through time. Then on top of that, the eminent psychologist Martin Seligman at the University of Pennsylvania, after 3 decades of study, thinks that the single best predictor of that is optimism. Yep, optimism. Until next quarter, let's focus on the things that we can control, like spending time with our families and just enjoying life, and not focus on the things that we can't control, like the market or the outcome of the upcoming election. Life is too short to not be optimistic. Remember that. The end. Again, I'm David Adams. Thank you for joining me.